I'm going to start sharing the screen with the questions. First question, it's very simple question. Those are the terminology, and insert the letter of each terms of in the blank space besides the definition the most closely matches. So you have to find out which one is cash discount, which is your grace period, which is discount period, which is free on-board destination and free on-board shipping point. What's the gross profit? What the merchandise inventory is? Purchase discount, sales discount, and trade discount. Obviously, the answers are on the second page. That will be for something for you to go over by yourself. The second question, let's see where the journal entries are. So the second question is also interesting question. I'll tell you why it's interesting question. Because dealing with simple calculation of the net income, net loss, by having sales, cost of goods sold, gross profit, operating expenses, net income loss. So here, obviously, you have to fill the gaps with the missing numbers, but I don't think you're going to have problem. The logic here is, let's see this one, for example. Net income is loss achieved. The company is losing $5,500. But we have the sales and cost of goods sold. Once we get sales minus cost of goods sold, it's going to give us gross profit. Question is, how much should be the operating expenses where from that number, which will be positive number, to go down to the negative 5,500. So obviously that will be that number plus 5,500 to bring 5,500. And follow the same logic. Again, the answers are on the second part. This is just to get comfortable with this calculation. Sales, cost of goods sold, gross margin, gross profit from sales, operating expenses, net income. Again, nothing scary with this question. Let's see question number 3. Okay, this one is a little bit more interesting, and I want we to go over this question a little bit more in details. So here we have those two companies, Better Company, a retail store, that have the following transaction in March. Purchase merchandising from Alpha Company under the following terms. Paid shipping $125 for shipping charges. Return to Alpha Company unacceptable merchandise that had invoice price of $300, cost of Alpha $165. Send check to Alpha. So what we have to do is, assuming that both Better and Alpha are using perpetual inventory system, we have to prepare journal entry for Better Company and prepare journal entry for the Alpha Company. So what I can do here is I can copy this and move to the Excel spreadsheet. And we can do this on Excel spreadsheet. Let's try to do that and see what's going to happen. Give me a second. I have to deal here with two files that I have open on the Excel spreadsheet. And okay, have the question, and we can start working on the journal entries. Still having problem with this Excel. For some reason, the Excel doesn't share when I open it. Let me try again to share this Excel spreadsheet. Yesterday, I have same problem with another group. Oh, there we go. Now it's here. Can you guys see my Excel spreadsheet?
Yes.
Yes, prof.
Yes.
Okay.
Professor.
Yes, prof.
Okay. Sorry? Okay, great. So let's go one after another. First, what we have to do. Let's go from the point of view of, let's see, let me check the requirements. What was the requirement? The requirement, both company using the perpetual inventory system. And what we have to do is prepare the journal entry for both beta and alpha. First, present the journal entry for beta company, and then we should prepare the journal entry for alpha company. Let's go parallel. We can use it. I can do this parallel, so you can see the both how one company is gonna have to deal with the problem and how the other company is gonna deal with the problem. Now that will be our beta. And here we're gonna go with alpha. Let's make it a little bit bigger so we can see it better. Okay. So we have the starting point. The first one is on March. What's happened on March 2nd? On March 2nd, purchase merchandising from Alpha, so beta purchase merchandising from Alpha under the following terms: 1,800 invoice price, 250 and 60, free onboard factory. The cost of the merchandise to Alpha company was $990. So for the beta company, what they get? Since they purchase the merchandising, they get the merchandising, right? That will be debit inventory. Since both company using the perpetual inventory system. Once they're using the perpetual inventory system, everything goes to inventory account. We're not dealing with the purchases, we're not dealing with anything else. So debit inventory for $1,800. We do some adjustments here to the amounts. Okay, that should do it. And then we're going to have credit. Since they're not paying cash, credit will be accounts payables for the same amount, $1,800. Now that's for the beta company. Let's see what's going to happen in alpha company. Again, that's on the March 2nd. We're not going to change the date. But on March 2nd, this company is selling. So what will be that for them? Debit, since the other guy is not paying, that will be accounts receivables. How much will be that accounts receivable? Same amount, 1,800. But the sales, let me format those here. But the credit now is going to be sales revenue. For $1,800. And since this company running the perpetual system, at the time of the sales, we have to record the cost of goods sold and reduce our inventory. We already have the cost of our merchandising in our company, so we can easily do debit cost of goods sold for can move this one just to be consistent. 1,800 here, and this will be $990. And credit's gonna go inventory. Inventory is gonna go down with $9,900. And that's the same transaction under both companies, as you can see. So accounts payable in one company become accounts receivables in the other company. Same amount, everything is the same. The inventory that this company is reducing is different, because obviously this company is going to generate gross margin right away. Now let's see what's the next one. This company paid shipping for the shipping charges for the purchase on March 2nd. So what we're going to do here, I'm going to drop this one a little bit so we can have it. And that happened on March 3rd. March 3rd. Debit inventory in this case for the freight, which freight is 125, and credit they pay in cash, otherwise they cannot get the goods, that will be 125. This company, they don't have to do anything. They're not the one who have to pay anything related to the shipping. So the March 3rd, there will be nothing, not applicable for this company. So the next thing, what happened, the next thing, I'm going to keep moving this requirement so we can drag it with us so we can prepare the journal entry. Next thing that happened is on March 4th. On March 4th, Alpha Company, which is, this is our, let me do some magic here. So Alpha Company returned to Beta Company, returned to Alpha Company unacceptable merchandises that had an invoice price $300, which are at cost of Alpha 165. Alpha returned the merchandise into the inventory. So once the Beta returned the items, they don't have to pay anymore. And they don't have it in their inventory. So let's reduce the debit accounts payable to reduce the accounts payable for amount that they return it. They return in $300. And credit, we have to reduce the inventory because we don't have them. They're going back to Alpha. And that will be 300 here. Now in Alpha, what they're going to do in Alpha, on the same date, March 04th, they're going to accept that inventory. They're going to accept the inventory. Let's go with the inventory first. Debit inventory. They have it back in inventory. That for them, that inventory costs with $165. Now they have to reduce the cost of goods sold. Credit, cost of goods sold, with the same amount. 165. Now, once they accept that return from Beta Company, the Beta Company, that sales is canceled. So 165 is the cost, but the sales is for $300. So now we have to reduce our sales revenue, but we're not going to go directly to sales revenue. We're going to go to debit sales return and allowances account for $300, and we're going to reduce accounts receivable because these guys, they're not going to pay us $300. Credit accounts receivables with $300. And we're done. Now, on March 17 is the last transaction. March 17. Beta company send check to Alpha company for the purchase MyStack. So let's see now how much Beta company needs to pay. That will be the first thing that we have to calculate. So let's open this accounts payable account here, which is going to look like this. My surface here is so slicky. Anyway, accounts payable here. So first, we need to pay $1,800, correct? $1,800. But then we have return for $300. So in total, we need to pay $1,500, correct? $1,500. Now we've made the purchase on March 2nd, and we can take 2% as a purchase discount if we pay within the 15 days. Is the March 17 within the 15 days from the purchase? Looks like it. So can we take 2% of the outstanding accounts payables? Yes, we can take. So do we have to pay $1,500? Absolutely no. But we're going to close those $1,500. So our first will be debit accounts payable, and we're going to debit this account for $1,500. Now, the question is, how much cash we have to pay? I made some mistakes here. Let's put this one 1,000 here. So we pay those accounts payable 1,500. How are we going to pay? The question is now, how much cash we're going to pay? We're going to pay 1,500 less the 2%. So the credit will be cash, and we're going to pay, that will be equal to 1,500 minus in brackets 1,500 times 0.02%. Let's see what is my mistake here. Oh, probably that's common. So we're going to pay only $1,470. What's going to happen with the $30? That's going to be credit directly to the inventory with $30. So our inventory becomes cheaper with another $30. Now what's going to happen with the other company is in the other company, we have to calculate how much is their accounts receivables now. I'm going to leave this one here, and we're going to grab this format here. I'm going to paste it here to check out their accounts receivable. Accounts receivable, that obviously will be on the opposite side. So first, they have to collect $1,800. But what happened is they give them discount, sales return allowance. They give them sales return allowance for $300. So in total, they're supposed to collect 1,500. But are they going to collect 1,500? Obviously not. Why? Because they give them another 2% if they pay within 15 days, which in fact they paid. So these guys on March 17, they're gonna receive cash for exactly same amount. Because this check that this guy is writing, it's gonna come to Alpha Company for $1,470 only. But these people, they have to close accounts receivables for $1,500. Now we have a difference on the debit side. What will be that difference? Where that difference is going to go? That's going to go to sales discount for $30. And our job is done. So you can see now parallel what happened with the company that's purchasing and the company that's selling. And exactly how the same amount going from one company to another company until the ending point that when this company send the check to that company, it's selling. This company is not going to get any different than this amount because this company is the one who's selling. But the company is the one who's selling through the Alpha. So they're just going to receive $1,470 and they have to close accounts receivable $1,500 because these people closing accounts payable for $1,500. $30 for this in better is going to reduce the cost of the inventory. For Alpha, it's going to reduce the sales, also sales discount. Make sense? I like this question because it shows you on the both sides how everything is done. And since we have it recorded this time, we don't have to worry too much because we have it available now. Now we have to place this one here, and we have the question. Don't worry, I'm gonna post you this Excel spreadsheet later on together with the recording. Let's see, can I find something with very quickly if I can find that was question. That was question 3. Let's see how the question 4 is. Question 4 is for the preparation of multiple step format income statement. That's a good exercise with a very detailed explanation how to do it. I'm going to leave it with you because that's more like a technicality rather than some specific knowledge. And also, if we have to prepare the income statement for the final exam, you're going to have all those lines available. So what you have to do is just to follow the format and choose the right terminology, and you'll be there. That's with that question. That's question 4. Let's see question 5. What's interesting with question 5? Yes. The question 5 is the one that, again, I want you to pay attention because question 5 is going to show you calculation for the cost of goods sold under periodic system. Please spend a little bit time, get the idea of the calculation of the cost of goods sold under periodic system. We're starting with the purchases, less purchase discount, less purchase return allowances, add the transportation in or freighting, cost of goods purchases. Get the beginning inventory, get the cost of goods purchased. minus the ending inventory, cost of goods sold. That will be cost of goods available. That should be purchased. That should be available. If you want to make changes, just make it changes. That will be cost of goods available. That will be more accurate. And then you have to prepare this calculation of the gross profit. Start with sales, less sales discounts, less sales return allowances, get the net sales. Less cost of goods sold, gross profit. Less the expenses, net income. And then fill the gaps. One thing I want you to know, there's no negative amounts here. So you need to know that purchase discount and purchase return allowances has to be deducted from the purchases. That's the catchy part here. That's where you make a mistake if you have to prepare this on the. So here now they're showing us a negative amount, but not in this case here. So here you have to know that purchase discount and purchase return allowances are negative. They have to be deducted from the purchases. Then add the transportation cost. Then add the beginning inventory, get the available, minus the ending inventory, that will be negative, get the cost of goods sold. This is the calculation, again, cost of goods sold under periodic system. Save this one. And the last question, which is question 6, so actually that's question 6 for the purchases. Let me see. That's again the perpetual system, perpetual inventory system. We have here multiple questions on the perpetual system. As you can see, with the different scenarios, question 3, question 2, question 3, question 4, with the answers here. Please spend a little bit time to see. There's no different than the question that I just show you. And the same idea you have under the next question, which is dealing only with the sales. Again, we're dealing with the perpetual system. That's question 1, 2, and 3. And here you can see actually the sales return and sales discount from the selling point of view. Accounts receivables, then you have cost of goods sold, then you have again accounts receivable sales, then you have return for the merchandising inventory, sales discount on the payment, return sales return allowances. Spend a little bit time on those questions and let me know if you have any problems with those.